So you've spotted some rock bottom real estate prices and you're thinking, hey, maybe it's time to become a landlord. Tempting, right? But wait, before you start continuing your future rental income, there is some crucial financial info you need to get a handle on. My name is Katya Molina, and in this video, we will walk through the 8 key numbers you absolutely must know how to calculate and use when evaluating potential investment property. Mortgage payment. When buying a place to live, most lenders like to see your total debt-to-income ratio stay under 36%. Basically, it's all your monthly debt payments compared to your monthly income, but they might stretch it to 45% if you have a good credit score or solid cash reserves. For just the housing payment, they usually want it to be between 28% to 33% of your gross income. Now, things change slightly if you're looking at an investment property. According to Freddie Mac, the max debt-to-income ratio they will consider is also 45%. This number is super important because it directly affects how much the bank will lend you. Ultimately, whether you can afford the property you've got your eye on. Down payment requirements. Let's talk about the cash you need upfront. If you're buying a home to live in, things can be pretty flexible. For example, with FHA loan, you might get away with putting down as little as 3.5%. But when it comes to investment properties, it's a whole different game. Investors' mortgages typically require a down payment around 20 to 25% and sometimes up to 40%. Plus, all that money needs to come from your own pocket. You can use gift funds for down payment or closing costs on investment property. How much you need to put down will depend on several factors: your debt-to-income ratio, your credit score, the price of the property, and the rent you expect to charge. Lenders use these factors to determine how much risk they take, determining your down payment. A rental income to qualify. Now, you might think, hey, the rent from my tenants is going to cover my mortgage, so I should not need an extra income to qualify for the loan, right? Well, it's not that easy. First, if you want the rent you charge to count as an income on your loan application, you must show you've been renting for at least 2 years. That's right, lenders want to see a solid track record of managing investment properties before considering rental income. In addition, you need to secure rent loss insurance that covers at least 6 months of gross monthly rent. This is a safety net for you and reinsurance for the bank if you suddenly don't have tenants. Also, if any of your rental properties are losing money, that loss gets added to your debt column when calculating your debt-to-income ratio. Price-to-income ratio. This ratio is a quick way to gauge affordability in a particular area by comparing the median home price to a median household income. It is a snapshot of how accessible home buying is for average family. Let's look at some numbers to get a clear picture. Back in 1988, this ratio was about 3.2. In 2019, right after the housing bubble burst, it was sitting at 3.3, but things have changed quite a bit since then. By October 2020, this ratio had risen to 4 before this housing bubble popped. It peaked at 4.66. What does it tell us? A higher ratio indicates that the homes are becoming less affordable compared to income. Understanding this is crucial because it can affect everything from choosing where to invest to predicting market trends and potential for appreciation. Price-to-rent ratio. This handy metric helps you decide whether buying or renting in a particular market is smarter. To get this ratio, divide the median home price by the median annual rent. This gives you a clear comparison of costs in the different areas. Here's how you can use it. If the ratio is under 15, buying rather than renting is typically better. It means buying is more cost-effective in the long run. However, if the ratio is over 20, you're better off renting since home prices might be inflated compared to the rental costs. This ratio is not just for potential homeowners. For investors, a high-price rent ratio can be a red flag. It often means the market might not offer greater investment returns because the initial cost of buying are high compared to the rental income you should expect. Gross rental yield. This metric is all about understanding your return on investment from renting out a property. To calculate the gross rental yield, you take the annual rent you expect to collect and divide by the total cost of the property. Then multiply that result by 100 to convert it into a percentage. This gives you a clear picture of your potential income before expenses like maintenance and taxes are factored in. The total property cost isn't just the purchase price. It includes all closing costs and any money you've spent on renovations. So make sure to add every dime you put into the place to get an accurate calculation. Why it is so important? A higher rental yield indicates a more profitable investment. It helps you assess if a property is worth the upfront cost based on the income it could generate. It's a straightforward way to compare properties and decide where your money might work the hardest for you. Capitalization rate. This number is a step beyond the process rental yield because it's considered a property's operating expenses, giving you a clearly picture of the actual profitability. To calculate the cap rate, start with the annual rent you expect to collect, then subtract on annual expenses associated with running the property. Divide that number by the total property cost and multiply by 100 to get your cap rate percentage. What counts as expenses? We're talking about repair costs, property taxes, landlord insurance, costs associated with the potential vacancies, and agent's fee, pretty much anything it costs to keep the property up and running. Why is the number so crucial? Because the cap rate shows the potential return on investment, factoring the everyday cost of owning and managing the property. A higher cap rate typically indicates a better investment, especially if you're comparing similar properties in the same area. Cash flow. Cash flow is all about what's left in your pocket each month after all the bills are paid. As a landlord, you are in a good shape if your rent covers the mortgage, including principal, interest, taxes, and insurance. But it's not just about breaking even. You might think ahead. It is crucial to have cash reserves on hand. Why? Because vacancies happen and unexpected maintenance costs are part of the deal when you own a property. Negative cash flow occurs when expenses outstrip income, often because too much was borrowed to buy the property in the first place. It can lead to serious troubles like defaulting on your own loan, unless you can sell the property quickly and for a profit. So managing your cash flow wisely means ensuring your rental income covers all costs and leaves a cushion for unexpected. This is essential to maintain stability and profitability in your real estate investments. If you still have any questions, drop a comment here below this video. Also follow me on my Instagram account, which is realtor.katya. See you in the next video.